There's a really fascinating puzzle playing out in the market right now. You've got Blue Owl Capital, a major player in two of the hottest sectors out there, private credit and the whole AI infrastructure build-out. But here's the thing. While the market's been climbing, their stock has been hammered. So the big question is why? Is the market seeing a huge risk we should all know about, or is this one of those major opportunities hiding in plain sight?
And I mean, look at this. The numbers really tell the story. The S&P 500 having a great year, up 13%, but Blue Owl Capital down almost 50%. A drop that steep, especially when everything else is going up, is a massive red flag for investors. So what in the world is causing a disconnect this big? Let's dig in.
But here's the twist. The company's leadership, they are flat out rejecting what the market is saying. Co-CEO Marc Lipschultz has gone on record saying that the fears dragging the stock down are, and I quote, ungrounded. He's making a pretty bold case that Wall Street has this story completely backward.
So here's how we're going to break this all down. First, we'll tackle that curious disconnect. Then we'll get into the weeds on the private credit jitters. After that, we'll look at Blue Owl's side of things, their bull case and their massive bet on the AI boom. We'll explore how they're structuring that bet. And finally, we'll get to the million-dollar question. Is this all about fear, or is it a real opportunity?
Okay, first up, this disconnect. It's kind of weird, right? We're in a bullish market, stock indexes are hitting record highs, banks are doing well, so why are investors running from a big player like Blue Owl? What are they seeing that's making them so nervous?
All right, before we dive deeper, let's just make sure we're all on the same page about what private credit actually is. It's pretty simple, really. It's just when investment funds, like the ones Blue Owl runs, lend money directly to companies. So instead of going to a regular bank, a company goes to them. And this is a huge, huge part of Blue Owl's business.
So, let's get right into these so-called private credit jitters. What's actually got investors so spooked? Well, it seems to boil down to three main concerns.
First off, you've got these high-profile defaults that are grabbing all the headlines. When companies like an auto parts supplier, First Brands, or a subprime lender, Tricolor, get into trouble, it starts to create this story. A story that maybe the whole private lending world is way riskier than it looks.
Then, on top of that, there's this general cloud of fear around fraud. We've all seen the headlines about borrowers maybe duping their lenders. This stuff creates a ton of suspicion over the entire credit market, and that anxiety definitely spills over and hits firms like Blue Owl.
And the third thing? This one's specific to Blue Owl. They tried to merge two of their own credit funds, but the deal fell apart. Why? Because one of the funds was trading on the public market for way less than it was actually worth. And from the outside, for investors, that just looked bad. It seemed to confirm that, yeah, something must be wrong here.
Okay, but now let's flip the coin and look at Blue Owl's side of the story. Co-CEO Lipschultz says the market is just panicking over a few stories, not the actual data. He's arguing the business is basically a fortress built on solid facts, and he's got the numbers to back it up.
And this is the number right at the heart of their defense. Get this, even with all the negative headlines and fear, Blue Owl's top-line revenue grew by 20% in the last year. I mean, that kind of performance just doesn't square with the story of a company that's in deep trouble.
Lipschultz is basically saying the market is connecting dots that shouldn't be connected. He says the fears about defaults are just anecdotes from, in his words, a corner of the world that isn't private credit. He's essentially telling everyone, hey, that's not our business, that's a different kind of lending, and it has nothing to do with our portfolio.
And this leads to his big logical argument. See, Blue Owl is what's called a senior lender. That just means if a company gets into trouble, they are first in line to get their money back. So his point is, it's fundamentally incompatible to be worried about the people at the very front of the line, while also being excited about the stock and bond markets, who are way, way at the back of the line. If Blue Owl were really in danger, the whole market should be on the brink of collapse.
All right, now let's switch gears, because there's another huge piece to this puzzle, the AI spending spree. Tech giants are pouring billions into building data centers for AI, and Blue Owl is bankrolling a lot of it, which of course has raised a new question for investors. Are we in an AI bubble, and is Blue Owl way too exposed?
And the scale we're talking about here is just mind-blowing. In just the last couple of months, Blue Owl's funds have put up over $50 billion to build these massive data centers for the biggest names in tech. We're talking Meta, Oracle. These are some of the largest privately funded projects in modern history. It's absolutely huge.
So you might be asking, how is Blue Owl managing the risk of a potential bubble? Well, their strategy is simple. They're betting on the infrastructure. They're not trying to pick which AI company will win. They're making a much safer bet on the essential stuff that all of them need. It's the classic picks and shovels play in a gold rush.
And this visual just nails the strategy perfectly, right? On one side, you've got the speculators digging for gold. They're all betting on which specific AI company is going to strike it rich. And on the other side, you've got Blue Owl. They're the ones selling the picks and shovels. They don't care who finds the gold because they know everybody needs to buy tools from them. In this case, those tools are data centers.
And this is why they call their setup ironclad. It's a pretty straightforward and honestly pretty brilliant four-step process. 1, they build a real physical thing, the data center. 2, they sign a super long 15 to 20-year lease that can't be canceled with a company like Meta or Microsoft. 3, that lease is guaranteed by the parent company, one of the richest, most creditworthy companies on the planet. And 4, they just collect the rent.
So that brings us right back to where we started. Fear or opportunity? You've got these two completely opposite stories crashing into each other over this one stock. The market's anxiety versus the CEO's confidence in the cold, hard facts.
Let's just lay it all out side by side. On one hand, you have what the market sees, scary defaults, that failed merger, and the fear of a potential AI bubble. But on the other hand, you have what the CEO sees, 20% revenue growth, a belief that the fears are just based on anecdotes, and these ironclad leases with the biggest, safest companies in the world.
And Lipschultz really leaves us with this powerful take, basically echoing Warren Buffett. He doesn't see a crisis at all. He sees a moment where the market is fearful for what he calls ungrounded reasons, and that, to him, creates a prime opportunity for anyone who sees things differently.
And that really is the ultimate question here, isn't it? You've got the collective wisdom, or maybe the collective fear, of the entire market on one side, and on the other, you have the confident, detailed reality presented by the guy running the company. When they disagree this much, who do you bet on?